Hello, very good morning to all, and welcome to today's Daily Dose of Market Insights. I'm Kelvin here again. Very good morning to all. Today will be Tuesday, the 17th of September 2024. So before we jump into today's Daily Dose of Market Insights, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product. Pardon me. Any forecast, prediction, projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. Okay, so as usual, before we start our daily dose of market insights, let's, in terms of the intraday technical element component, that has a quick recap of what has taken shape yesterday in terms of news flow, economic data release, and as well as the intraday performance of the broad-based cross asset classes. So let's start with the news flow first. All right. So news flow yesterday, very interestingly, we do see kind of, I will put it away that pressure on the US Federal Reserve to enact a jumbo 50 basis point cut tomorrow. That means, i.e., we're talking about 2 a.m. Singapore time on Thursday. So why do I say so? Because we do have two very interesting thing is this bunch of there's this three Democratic senators, that means politician, putting political pressure on the Fed to instead not cut by 50 now, they're urging Fed to cut by 75 basis point. So there's this throw of Democratic senators. Warren, I believe that most of you actually follow the US political cycle. Warren is very pro middleman, less pro business. White House and Hickenlooper, they actually signed a letter and sent to Powell, urging Powell to cut 70 basis point. All right, and another very interestingly, ex-Fed officials, Bill Dudley, formerly I believe he's the New York chief, the New York. The New York chief, you know that Federal Reserve officials, they are being broken down by various districts. So he belongs to the New York side. So he actually wrote an opinion piece in Bloomberg, releasing just 2 days before the Fed meeting, urging the Fed to actually cut by 50 basis point. So what we could see over here is that there's a swing of pendulum. Okay, initially the market is actually looking for a 25 basis point cut. Right now, the Fed, there are actually circles within the economic committee, which Bill Dudley belongs to, circles within the political committee, which is this throw of Democratic senators due to this upcoming US presidential election, asking the Fed to actually do more to improve the situation, the consumer and business confidence, okay, way ahead of the US presidential election. So right now, the story seems to be asked over here is that there are some signs in the economic side. This is more on political pusher. And whereas this guy over here, he belongs to the economic committee. That means why 50 basis point? Because he do believe that the US may have really slipped into a recession. But nevertheless, if the Fed were to actually go such big increase in so-called interest rate cut, it doesn't actually gel well to those much more aggressive risk assets or quite higher beta risk assets that actually lead the stock market since the start of this year. And that price action has been reflected in the intraday performance of the major US stock indices yesterday. So if you look at the intraday movement of the US stock indices yesterday, the Nasdaq 100, that is considered as the higher beta stock index, that means it's more sensitivity to risk, and that means, i.e., if we are talking about market is very risk loving, it will be the one that lead the market because it's heavily concentrated in those technology name considered as growth and we call it the next big thing stocks like Nvidia. All right, so by yesterday, because of this fear of a recessionary scenario that may already slip into the US economy by certain part of the political cycle, the economic committee urging the Fed to actually do much more by a 50 basis point cut, 75 basis point cut instead of a normal 25 basis point cut. So that actually explained the underperformance of the Nasdaq 100 yesterday, down negative 0.47%, and the outperformer continues to be the Dow Jones and the Russell 2000. So Dow Jones Industrial Average, because we do have certain component stocks that belong more on the defensive side of the play. That means, i.e., these particular stocks will perform much better during a recessionary period, like healthcare and as well as utility stocks. So it's up by 0.55%, and the Russell 2000 up by 0.31%. The S&P 500 almost unchanged at 0.13%, was given the fact that the S&P 500 also do have a significant weightage on those mega cap technology growth name that is actually part of the higher beta cohort that is driving the majority of the US stock market gains since the start of this year. And if you look at the breakdown of the S&P 500 very clearly, right, the one that lead the bleeding yesterday was these two big cap stocks inside S&P. In fact, three of them. Amazon down negative 0.86%, Apple down almost 3% at negative 2.78%, and mind you, Apple is the number one biggest weighted cap in the S&P 500 and the Nasdaq 100, and Nvidia is the third biggest cap in the S&P 500 and Nasdaq 100, down negative 1.95%. So it's more of a rotation play into the rest of the other sector of the US economy. So right now, right, and what we could see over here is that yesterday we also see a slew of dollar weakness coming back into the picture as well. So this should be, as of now as we are speaking, not 13th of September, it should be 17th of September. So based on this 5-day rolling performance chart on the dollar major against Mr. Dollar against the rest of the other major currency. Very clearly, if we all see all this line that is coming downwards, pointing downwards, it represents dollar weakness. Okay, so let me push to 17th of September again. So basically what we see over here is dollar is actually gaining a lot of weakness against the rest of the other major currency. Okay, but nevertheless, we got to be bear in mind over here is that we know that the trend, the 5-day trend is down, but on the intraday basis, right, there could be certain signs of dollar bounce coming back ahead of the US Federal Reserve, because don't forget, in the last 1.5 weeks, the dollar has almost sold off pretty much significantly across the board. Okay, so that we know that in terms of technical analysis, price don't go vertical up and vertical down, they oscillate within a trend. So there could be some signs of a potential bounce, dollar bounce, going forward before the this so-called US Federal Reserve this coming Wednesday, i.e. 2 a.m. Thursday Singapore time. Later I'll touch more about that when I cover the short-term intraday technical outlook on the dollar major pair. But for now, the 5-day trend, that means i.e. we're looking at from a multi-day perspective, it's still pointing on the downside for dollar weakness. Then now for gold over here, gold price yesterday tried to break above fresh new all-time high, hovering around that 2,590 level, but there's still no signs of a exhaustion to see it crashing downwards. Why? Because it's still being supported by this ongoing interest rate cut that going to be enacted on this coming Wednesday, or i.e. Thursday 2 a.m. Singapore time. Right, so these are actually the news flow that actually taken shape yesterday, and as well as today's. There's no during the Asia session, there's no other key economic data that I'll to share with you guys. So now let us immediately jump to the next segment of our daily dose, which I will cover a more medium-term horizon perspective. That means focusing on a fundamental element together with some intermarket dynamics. Potentially it could take shape from a multi-week to multi-month perspective, and this coverage I would like to cover more on the health of the US stock market. Okay, so I think this chart should be the first time that I showed you in my slew of daily dose of market insights. So this particular chart Okay, pardon me, with the chart I'll share with you guys. Yeah, this is the chart. Okay, so this chart I'll share with you all is actually a ratio chart. That means what I did over here is I plotted the key sector of the S&P 500 and one particular key industry and a key cohort stock. Why? Because later I'll explain to you why I do that. Okay, but first and foremost, we take things one at a time. That means this is a chart which I can do it on trading view. I can select any time period, and from that time period I could start from that particular baseline until now. So what I did over here is that I start from 16th of July this year all the way until right now current price action. All right, and this is the US we call it stock market using their various ETF. So this will be the closing price as of yesterday because it's not trading now since the US cash stock market is closed. All right, so why I start from 16th of July 2024, because this is the date where the S&P made a fresh all-time high currently, and so far it hasn't broken above the high of 16th of July. So based on 16th of July, I want to know how the various key sector of the S&P perform. So I plot a ratio chart. So at the top, that means if you see this ratio chart that is going upwards, that means turning upwards, it represents it's outperforming the S&P. And very clearly, right, you look at this 1, 2, 3, 4 of them that is outperforming the S&P, but the ratio chart are considered as defensive sector. Utilities, real estate, that is their REITs, REITs. So those who actually invest in the stock market, REITs shouldn't be a very kind of a alien terminology. Why? Because why REITs is considered defensive? Because they give a constant dividend flow, and they will outperform when the interest rate environment gets lesser and lesser. That means a lower interest rate environment. And also consumer staples, consumer as a defensive play as well. Why? Because consumer staples at the end of the day, irregardless whether the economy is in a recession or not, people got to buy necessity, something like Walmart. So let's say, for example, if the economy is not doing well, people will spend less on luxury item, but all their whatever remaining cash at hand will focus instead on consumer staples products instead. Okay, and for sure, healthcare is also considered as a defensive. Why? Because healthcare, regardless of whether the economy is good or bad, people still need to visit the hospital and do medical checkup. And people, some we call it psychologists even do a test over here. Is that we know that if the economy does do well, people tend to be much more stressful. People will tend to fall ill more easily due to the stress level is increased. People will visit more on healthcare product and services. So that also potentially tell us that during recessionary period, healthcare stocks tends to actually outperform the general market using S&P over here. Okay, and what's interesting over here at the 1, 2, bottom 3 is these are the high beta sector. Okay, what I mean by high beta sector or high beta industry stocks or industry group as I group together. Why do you mean by high beta? High beta, what it means that over here is that if the market is very, very bullish in risk on mode, they tend to actually outperform the general market. Why? Because people will build up their share price. People are optimistic about the future growth of the US stock market, i.e. economy is doing well. This particular stock price will jump much higher, like what we see at the start of this year. Those mega cap 7 stocks, everybody is hyping about the AI optimism play, and I include in Netflix as well. Okay, with it. So mega 7 will be growth stocks like Tesla is one of them. We've got Microsoft, Apple, Google, all this. Okay, so but they start to actually turn flat, plateau. Okay, notice that they start to plateau off, flattish, very flattish since the fresh all-time high of 16th of July 2024, and also pretty much flattish on the information technology sector as well. So basically, put it away that information technology sector is a kind of a subset of the mega cap 7. Okay, but what interesting over here is that within the subset of a subset of a subset of Omega's Cap 7, this is the most niche one will be the semiconductor. So why do I select semiconductor? Because you know that semiconductor is related to chips, right? And chips are needed for this ongoing AI optimism, high productivity, growth team play that has been inside driven the bullish trend of the US stock market and even globally since the start of this year or even since 1.5 years ago. The subsector of this mega cap 7 and information technology is actually underperforming. Why? Because it's showing a series of higher, not higher, is a series of lower, higher over here. When I plotted against the S&P 500, the ratio of it. That means what you could see, right, this particular chart I'm trying to share with you all is, at this point in time, right, we know that the Fed, everybody start to price in a Fed cut already. Okay, the Fed cut already. But why this particular Fed cut that is being priced into the market right now, or in fact, a start of an interest rate cut cycle, because very unlikely the Fed will cut once and pause for a long period of time. There will be a series of cuts, which I highlight to you all in yesterday's daily dose by showing the CME Fed Watch to projected move going down 12 months ahead. So given that the Fed is about to cut interest rate, from a fundamental perspective, it should be very, very positive for the stock market. Why? Because lower interest rate, lower cost of funding will improve the bottom line of the balance sheet of corporation, i.e. we use less funding to fund our growth, and eventually profit margin will go up because my cost of funding is getting lesser, and eventually earnings per share should rise as well. But do not forget this one equation. What if revenue starts to fall? There will be less demand from the products and services of this company. So, but to answer the question, we need to look from a behavior perspective. So, based on a behavior perspective, by plotting this ratio chart, right, what market participants are now is pretty much concerned about the health of the US economy. Yes, the Fed is cutting interest rate, but in terms of the current relative strength performance across this key sector and key group of the US stock market, it's not actually skewing towards a outperformance of those higher beta risk loving sector and group US group of stocks. We don't see a clear outperformance of the mega cap 7 plus Netflix. We don't see a clear outperformance of the information technology. We don't see a clear outperformance so far on the US semiconductor since the fresh all-time high on the S&P 500 that was made on the 16th of July. But instead, the outperformance is being centered in on those defensive sector that tend to actually outperform during recession period. That means, i.e., if I were to be trading in the US major stock indices, I've got to be very cautious to be aggressively bullish on the Nasdaq 100, because those Nasdaq 100 and even the S&P, because they are heavily weighted by these guys over here. Mega cap 7, information technology, and even some part of this semiconductor as well. All right, and also bear in mind, this is a relative ratio chart. That means it doesn't mean that this guy can continue to go up. When talking about outperformance or underperformance, is if the entire market starts to fall, this guy will fall lesser than the S&P 500. That means the utilities, the real estate, consumer staples, and healthcare. But they can still may fall at the same direction, but at a lower speed, which means that this ratio or relative strength line, I would say the ratio, can continues to be in an uptrend. All right, so this is something mindful that we got to monitor as the Fed continues to embark on its interest rate cut cycle. That may not represent a very, very, we call it a risk-on behavior across the board. All right, so now that's the fundamental and the intermarket dynamics that I will share with you all for today. Now, with that, now let us now progress ahead and share more about the intraday technical outlook. All right, so with that, let me expand my screen so that you guys could see the key levels and chart much more clearer. So let us start with the FX market. All right, so still recall in the FX market, we know that the 5-day trend, the multi-day trend of the dollar weakness is still intact, but on the intraday basis, there could be oscillation and a potential what we call pullback of this dollar, we call it dollar weakness across the board. So now let us now start with the euro dollar first. All right, so on the euro dollar, this is the 1 hour chart. The euro dollar, if you still recall, yesterday we still have that bullish bias, so the euro dollar hit our resistance level at 1140, 1140 before it starts to trade sideways. Okay, so upon hitting the resistance level at 1140, the momentum indicator, this is a very short-term momentum indicator, which is the hourly RSI. The hourly RSI starts to shape a bearish divergence instead. That means what we could see over here is that price action starts to go higher, hitting the resistance yesterday. Okay, but the RSI is not moving as the same direction as the price. So the RSI starts to slope downwards instead. So bear in mind, still recall what is a momentum indicator. Momentum indicator is something like a rate of change. That means the RSI is telling us that this movement up, the rate of change is lesser. That means bullish momentum is getting lesser while hitting the resistance level that we highlighted yesterday at 1140. So given such movement of this euro dollar, there could be a risk right ahead of this before the key risk event took shape. That means on Wednesday US time, early Thursday Singapore session at 2 a.m. There could be some signs of a minor pullback first coming into the euro dollar. That means because euro is quoted against the dollar, that means some form of dollar strength coming back into the FX market, given that the euro dollar is the biggest weightage in the dollar index. And those who knows a bit of Elliott wave, right now we will start to see a mini 5-wave up has been completed on the euro dollar chart as well. If you look at screen over here, is that this wave 1, wave 2, wave 3, wave 4, wave 5. And we also the standardized 0.77 wave 5 target has really also been made very close to that 1140 level by doing the wave 5 projection over here, taking from the start of the low of wave 1, pull it up to the end of wave 3, the low of wave 4, the 0.618% as well. All right, and the 0.764 is at this minor swing high over here of 6th of September. So it's a range. So what I do over here is that I will use 11140/11160 today as my short-term pivotal resistance level, flip to a intraday bearish bias on the euro dollar, near-term support level to watch for this potential minor mean reversion decline scenario to unfold, 11070, followed by which is this graphical okay, let me remove all the Fibo extensions, this minor swing low here, and 11050 level, this former minor swing high now turns into a pullback support level as well. Okay, so these are the two near-term support level to watch out for on the intraday basis. But however, if price action continues to break up, that means we got to respect the price action and broke above 11160, then this intraday bearish bias will be invalidated to see the euro dollar moving up higher towards the next near-term resistance level at 112 figure level, followed by Y11235. Okay, that's for the euro dollar. Now, turning our attention next will be the sterling dollar. So the sterling dollar very similar as well, as price continue to move up and hit our first resistance level at this 132.20 slash 132.40 level. All right, so very interestingly, upon hitting the resistance level, the RSI also shaped a bearish divergence as well. Okay, right at the overbought level. Okay, and as price action going to push higher, so indicating that yesterday's push up, the upside momentum has started to ease off. And also in terms of the Elliott wave perspective, the sterling dollar also has moved up a 5-wave sequence as well. 1, 2, 3, 4, 5. Okay, so if we do the Fibo extension of a 5th wave target over here, is the 0.618 and 0.764 as well. All right, so in terms of the Elliott wave perspective, every time we see a 5th wave up and it hit a graphical resistance level, and this graphical resistance level confluence with a typical 5th wave target like the 0.678 and 0.764, after 5-wave movement up, there will be a potential retracement, kind of a deeper retracement to retrace around 50% to 61.8% of the entire prior 5-wave up move. Okay, so what we could see over here is a very similar movement at the euro dollar. So using the 132.20/132.40, which is the minor swing high of 6th of September, this will be my short-term pivotal resistance for today. Flip to a intraday bearish bias on the sterling dollar for this minor mean reversion decline to potentially unfold. First near-term support level to watch out for will be the 131.50. A breakdown below it exposes 131 figure level. So what's 131 figure level? If we do the Fibo retracement of this push-up, is confluence with the 50%, and as well as the former minor swing high of 10th of September and 11th of September now turns into a pullback support level. Okay, at 131 figure. Only a price breakout with an hourly close above 131.40, then we got to respect this ongoing strength in the sterling dollar to take us up much higher towards the minor swing high area of 28th of August at 132.65, then thereafter followed by 133.60. So what's 133.60? If we go to the daily chart over here, okay, is this former congestion area over here. Okay, from 16th of December, previously supported, 22nd of January 2022, broke down, turns into a pullback resistance on 4th of March 2022. Okay, so that's about close to 2 years back of resistance level graphically. Okay, so that's for the sterling dollar. Okay, now moving our attention next will be the Asia Pacific currency, starting with the Aussie dollar. Okay, so Aussie dollar yesterday, we are looking for that push up over here to at 67.60 for a bearish buyer's opportunity. So indeed that price action now push up and almost hit our short-term pivotal resistance that we highlighted yesterday at 67.60. And what's interesting yesterday is that as the price push up already completed this push up very close to the 67.60 short-term pivotal resistance that we highlighted, the hourly RSI also shaped that bearish divergence as well. Okay, can you see here? Price action move higher high, but the RSI is sloping downwards, okay, lower high. So it's also indicating that the price movement that has taken shape yesterday is losing upside momentum with the risk of shaping that minor corrective pullback as well. And what's interesting over here is that since the low of 11th September, it also starts to trade up that very clear 5-wave movement. Wave 1, wave 2, wave 3, wave 4, and now it's the wave 5. And we do the 5th wave target over here. Okay, the point, oops, let me draw a proper one. The 0.618 also confluence very closely with the graphical resistance of 67.60. So that actually increases the odds of a potential deeper mean reversion decline to retrace at least 50%, a kind of a 50% of this prior 5-wave up. Okay, so with that, no change, still using 67.60 as my short-term pivotal resistance on the Aussie dollar. First near-term support level to watch will be the 20-day moving average, also adding confluencing with this graphical resistance near-term support level over here, 67.30. A breakdown below 67.30 exposes 66.90/66.70. So very clearly this next minor congestion near-term support zone. And if we do the Fibo retracement of this entire recent push up from the low of 11th of September, also a 5-wave move up that also confluence with the 50% Fibo retracement as well. However, if price starts to push up and have a breakout with an hourly close above 67.60, then this today's bearish bias view for that mean reversion decline scenario will be invalidated to see the continuation of this recovery on the Aussie dollar to seek the next resistance coming in at 67.95, followed by 68.20 next. Okay, so that's for the Aussie dollar. So now, what's next on the dollar yen? So what you see the dollar yen over here is that very interestingly, the dollar yen continues to push down. Different from the other pair, so indicating some form of still dollar weakness. And what's interesting over here is that the push down actually push right exactly as our first resistance level that we highlighted around 41.40. Yesterday we do have a key short-term pivotal resistance at this 42 figure level. All right, but given the yesterday's push down at the 41.40 and how it pushed down, it formed this hourly bearish shooting star formation And this push down also coincide with the lower boundary of this descending channel that the price has been oscillating since the high of 3rd of September, a short-term minor descending channel, and yesterday's bearish reaction with the shooting star exactly hit at the descending channel resistance level. Okay, so 40, this level was the support level that we highlighted. Let me remove this. Okay, over here. And what's interesting over here, right? The price action, right, when it comes down to form a lower low, lower low over here, the RSI, there is no clear bullish divergence as well. All right, so notice that your RSI, right, over here, it continues to see a lower low as well. Lower low, okay? And right now it bounced up. This bounce up over here is being restricted by this resistance over here. Okay, this resistance, parallel resistance. So what you could see over here is that the momentum of this push down yesterday is not losing strength yet. Very different from the one on the euro dollar, the sterling dollar, the Aussie dollar, where we see some form of dollar strength coming back, but not representing, not being shown on the dollar yen. So with that, right, I will use a very tighter short-term pivotal resistance for today, because if the price action were to continue its downward move, it shouldn't break above 140, which is also very close to the shooting star high, and also very close to the descending channel upper limit, which is the descending channel resistance at 14140. So using a Titan key short-term pivotal resistance over here, 14140 on the dollar yen, still maintain this ongoing bearish bias on the dollar yen. First support level to watch out for will be yesterday minor swing low at this 139.70 level. 139.70 level, a breakdown below 139.70 exposes the next near-term support level at 139 figure slash 138.75, which is the Fibo extension level. And as well as graphically, if you go all the way back over here, okay, this congestion area here at 28th of July, this minor congestion, okay, of this year. So only a breakout, that means if the price action starts to push up above this Titan key short-term pivotal resistance level at 14140, so that would invalidate today's intraday bearish bias on the dollar yen, to see another round of mean reversion rebound scenario taking shape to revisit 143 figure level slash 143.70, also converging with the 20-day moving average that is acting as the resistance level, very similar to 143.70 level as well. Okay, so that sum up the intraday technical outlook on the major dollar pair. Okay, so now let us now turn our attention to the major stock indices, starting with the Hong Kong 33. Okay, so the Hong Kong 33, yesterday we do have a bullish bias looking for the bounce to take shape. So the bounce has already hit our resistance level at 17,500, pardon me, 17,595. So this resistance level has already been met over here, and right now it's coming very close to the pivot, the next resistance level at 17,730 level over here. What's this level? This minor swing high area of 3rd of September. And if you do the Fibo retracement of this entire push down, okay, is close to the 61.8% Fibo retracement, which is the golden ratio as well. So overall, given that there's this confluencing of these two resistance level that is pointing at 17,730, defined by graphically and also defined by the golden ratio of 61.8%, and coupled with the RSI now back at the overbought region, there could be some form of at least a minor pullback taking shape on the intraday basis on Hong Kong 33. So given that price action already been pushed up very steeply, there could be a chance of a pullback in first step first. So with that, we will flip to a intraday bearish bias for today on the Hong Kong 33 using 17,730 as my short-term pivotal resistance level. So first support level to watch out for will be this level here, formerly resistance, now turns into a pullback support level, and so very close to the 20-day moving average as well. which is at 17,000. So it'll be a zone over here. Okay, let me put it. Okay, perhaps let me put it over here. Okay, yeah, that's better. Okay, tested one time, rebound, tested one time, came down and push up. Now turns into a resistance broken, now turns into a pullback support. Okay, which is very close to the 20-day moving average, acting as a support as well. 17,510 level. Okay, so 17,510, first near-term support level to watch. A breakdown below it, revisit this minor congestion area here, which was also tested a couple of times previously. Resistance break, now turns into pullback support, and so confluence with today's minor swing low at 17,390. All right, so let me remove this one as well. Remove this, remove this, remove this. Okay, so these are the two near-term support level to watch out for this potential minor bearish pullback scenario to unfold, as long as 17,730 short-term pivotal resistance holds. But if price action starts to break out above 17,730, then today's intraday bearish bias will be invalidated to see the continuation of the recovery in the Hong Kong 33 to revisit 17,930. So that's the 76.4% Fibonacci retracement. Above it exposes the minor swing high area of 30th of August at 18,160 / 18,235 level. Okay, so that's for the Hong Kong 33. Now turning our attention to the Nikkei 225. So the Nikkei 225, yesterday we were bearish below 37,170. Price action indeed has already hit our first support level and break down below it at 36,195. So this level here will be our pullback support level. Okay, so we will actually tighten our key short-term pivotal resistance for in today's Asia session high, which is also confluence with yesterday's Friday minor swing high here, touching these two minor swing point here, acting as the tightened key short-term pivotal resistance for today, given that price action already hit our first support and broken down below it. Okay, so this will be our tighten key short-term pivotal resistance for today, which is 36,000. Okay, 36,780. Okay, 780. Okay, so this will be a normal resistance. Okay, so using a tighten key short-term pivotal resistance level for today, I don't put it so tight at 36,195 just in case of any whipsaw again, because this is this level has not, it's just broken down, it hasn't retested yet. All right, so it can form a bit of tail back at this level at 36,195. That means a bit of whipsaw here before potentially coming down. So to prevent any whipsaw from taking shape, I'd rather use this much more clearer resistance at 36,780. So tighten it to 36,780. That will be my short-term pivotal resistance on the Japan 225, i.e. the Nikkei 225 today. We will flip to a intraday bearish bias. That means not flip, maintain that intraday bearish bias, pardon me, with the next near-term support zone coming in at 35,400 / 35,115. Only an hourly close back above 36,780 will invalidate today's intraday bearish bias for the price action to actually see a bit of a recovery in first step towards 37,170. A breakout above it potentially sees 37,570, which is also confluence with the 200-day moving average, acting as a resistance level as well, very closely at 37,570. So that's for the Japan 225. So what's up? Oops, sorry, that's for the Japan 225. Moving on will be the German 30. So the German 30 continues to trade sideways yesterday, holding above our short-term pivotal support level, which is also close to the 20-day moving average. So still no change, still using 18,600 as my short-term pivotal support level for the German 30. First resistance to look out for will be at this 18,020. Only a breakout above 18,020 may revisit the current all-time high area at 18,970. But however, if price action starts to push down and break below 18,600, then potentially we may see another round of choppy minor corrective decline to retest the 50-day moving average, also acting as a next near-term support level at 18,390 next. Right, so only a breakdown below 18,390, then potentially we will see further potential weakness on the German 30 to expose the next near-term support level at 18,160, which is this former minor swing low area. Break now turns into a pullback support level again. So that's for the German 30. All right, so now turning our attention will be the US Wall Street 30. So the US Wall Street 30, yesterday the price action continues to push up, clear above 41,453 level. So this will be something like a pullback support level to watch out for. And what we could see over here is that price action now the RSI hit the overbought level, and what we could see over here is that it starts to actually comes down into the back into the overbought, I mean below the overbought region over here. So as you could see over here, the price action, there's no bearish divergence. Price continues to shape a kind of a higher high on the RSI. Okay, very clearly there's no bearish divergence at all. Okay, a higher high. Okay, so if there's no bearish divergence over here, potentially given that it really come down from the overbought region, potentially there could be some form of a pullback over here. So what we could see over here is that this could be the pullback zone to watch out for. Okay, over here, that means yesterday's breakout level, and this 43,337. Okay, this could be the pullback zone to look out for. If okay, that means if this 41,535 gives way and it starts to reintegrate back again, so this could be the pullback zone at 41,337. So what I could do over here is given that yesterday price action already hit a higher high and clear above this 41,535, so I will use a slightly tightened key short-term pivotal support for today at this level here. Okay, very close to the 20-day moving average as well at this 41,105 level. So I'll tighten it to this 41,105. So as long as this tighten 41,105 short-term pivotal support holds in any potential signs of a pullback, because I don't want to put it so tight over here, because this level confluence with more elements, which is also the 20-day moving average, right? I think as a support at 41,105. So as long as 41,105 holds, we would still maintain our short-term intraday bullish bias on the US Wall Street 30. Next resistance level to watch out for will be at this 41,810/41,950, being defined by a Fibo extension cluster level. Only a breakdown below 41,105 that will invalidate today's intraday bullish bias on the US Wall Street 30 to start a minor corrective decline scenario to expose the next near-term support level at 40,620, which is also confluence with the 250-day moving average, acting as a support level as well, and also the lower boundary of this minor ascending channel that I drew from the low of 5th of August. So that's the US Wall Street 30. Now, turning our extension will be the Nasdaq 100. So the Nasdaq 100, yesterday we do have a pivotal resistance level here at 19,630. So no change. We will still maintain our short-term intraday bearish bias. Yesterday, price action hit the first support level at 19,320 before bouncing. But what I could see over here is that the RSI continues to remain weak so far in today's Asia session, continues to inch downwards after also, if you look at it over here, is that there's this support level that has been taken out previously, supported, then turns into a pullback resistance, and that is where it reacted off it. So indicating that downside momentum is still pretty much intact on the intraday basis. So with that, this still is the first support level to watch. That means, i.e., still maintain that intraday bearish bias. First support level to watch will be no change at 19,320. Only a breakdown below 19,320 exposes the next near-term support level at 19,090 for today. However, if price action starts to break up above the 19,630 level with an hourly close above it, today's intraday bearish bias will be invalidated to expose the next near-term resistance level at 19,900, which is this level here, 21st of August and 22nd of August, 19,900. All right, so that sum up the intraday technical outlook on the major stock indices. So let us turn our attention to the commodities market, starting with gold XAU/USD. All right. Okay, so gold XAU/USD continues to churn over here. So what we could see over here is that the price action. Okay, so what I could do over here, the price action now is coming close. Okay, let me highlight again. Okay, so this will be the first support level to watch out for. Okay, so you realize that after hitting the 2058/595 level, price action starts to shape that pullback over here. So this will be the first support level to watch, and the first resistance level, the pivotal resistance level remains unchanged. Okay, let's put it tidy up over here. So this will be the 2533 short-term pivot. Okay, so potentially a minor pullback taking shape, given that the RSI now has really exit from the overbought level and is turning downwards below the 50 level, hasn't hit the oversold region yet. So potentially there could be these two support level to watch for that pullback. So what we could see over here is in terms of Fibo retracement, taking into account of this push up. Okay, so this is the 23% and this is the 38% Fibo retracement level. So what we could do is as long as this 2,553 short-term pivotal, okay, so instead it's a zone. If I recall yesterday, I put back again, is this zone over here. Okay, let me push it back again. So it's 545. Okay, 545. 545. So this zone here, so as long as this 2553 slash 200545 short-term pivotal support holds in this risk of a minor pullback scenario. Okay, if this 2570 breaks away, this level holds. Okay, this zone holds over here, we will still maintain that intraday bullish bias on gold XAU/USD as it continues to trade within this minor ascending channel as well from the low of 9th of September. So next resistance level to watch after 2058/2595 will be 2600/2606, which is a 2 times Fibo extension over here. And if we do the cluster, this level, okay, from here as well. Okay, now however, if price action starts to break down below 2,545, then we may see a deeper pullback to retest the previous 4-week range resistance level that was in place since 20th of August, now turns into a very significant pullback support level at 2,532/2,526. We also confluence very closely to the minor ascending channel support level from the low of 9th of September, and as well as the 20-day moving average, also soon to be acting as a support at this region area as well. Okay, so that's for gold XAU/USD. Still maintain that short-term intraday bullish bias using 2,535/2,545 as the short-term pivotal support level. Now, turning lastly will be West Texas crude oil. So for West Texas crude oil, yesterday we were looking for that bounce to take shape, and that bounce almost hit our first resistance level at 71,015 level. All right, and also the RSI is coming very close to the overbought region as well. So with that, we'll be now looking at this level here. Okay, so this level will be our short-term pivotal resistance level, since it's coming very close to this dotted line. So this dotted line over here, if you look at the daily chart, it will be the former major symmetrical range resistance, okay, former major symmetrical triangle range support, pardon me, now turns into a pullback resistance level. Okay, and right now the price action is also trading very close to the downward sloping 20-day moving average, also confluencing with this resistance zone area as well. So with the RSI now coming very close to the overbought level, there could be a chance of a slight back down again for the West Texas crude oil. So with that, I'll be using this level here. Okay, seems to be hanging out. Okay, so let me say it verbally first, since it's coming very close to, okay, so this level here, 72.20/73.15. So this will be my short-term pivotal resistance level for West Texas crude oil. Okay, SD pivot. Okay, West Texas crude oil. So we will flip to a intraday bearish bias for today, since price action is almost coming close to the 71.15 resistance level that we already highlighted for yesterday bullish bias and last Friday bullish bias level. Okay, so support level to look out for today on an intraday basis will be at 68.90 level, 68.90 level. Okay, let me put it in writing. Okay, why is not showing? Let it wait for a while. Okay, yeah, good. 68.90. That will be today's intraday support level to watch. A breakdown below 68.90 may expose. Okay, wait. This level next, 67.40. Okay, so these are minor support zone to watch on the intraday basis. Okay, just to sum up everything, since price action has already hit our resistance level where we have a bullish bias yesterday at 71.15, I'll use this 72.20/73.15 as my short-term pivotal resistance. Why? Because it confluences with much more higher time frame significant element, the dotted gray line, which is the former major range support, now turns into pullback resistance, and also the 20-day moving average acting as a resistance as well. First near-term support level to watch in today's bearish bias will be 68.90, followed by 67.40. Only a breakup above 73.15 level will invalidate today's intraday bullish bias to see the continuation of this mean reversion rebound to extend towards the next resistance level, which is this area here at 75.07. Okay, 75.07. Okay, level. Okay, so that sum up the intraday technical outlook on West Texas oil. All right, so with that, that also sum up the intraday technical outlook on the major cross asset classes. So before we go, let's take a look at the calendar to see what are the key economic data to look out for today. So in today's Asia session, nothing interesting, except during the start of the European session, we have one ECB official watch speaking at 3:30 p.m. Singapore time. And at 5 p.m. Singapore time, you have the Eurozone Economic Sentiment Index for the month of September, and another ECB official speaking at 5 p.m. Singapore time, ECB Macau. And for those who are looking at the dollar Canada, which I don't cover in my daily dose of market insights, there will be Canada inflation rate out at 8:30 p.m. Singapore time, and more on the US market and also impact the dollar as a broad-based basis will be one of the key economic related growth data in US, which is the retail sales figure out at 8:30 p.m. Singapore time. All right. And what we could see over here is that at 9 p.m. Singapore time, we have another ECB Edison officials speaking. And over here will be a rather quiet US session thereafter. So tomorrow Asia session, nothing pretty much interesting except for Japan exports that could impact the Nikkei 225 will be out at 7:50 a.m. Singapore time. So with that, that ends up today's daily dose of market insight. I wish you all a great day ahead, and we shall speak again tomorrow. Thank you.